Uh, Now we have Ma'am Rajshri Murkute. She is a professional banker, but now the credit rating company specializing on infrastructure is what she is heading the infrastructure division. And I'd like to invite her for a presentation from a rating analyst point of view related to how the markets are. It'll take some time. You want to say something, Pai?
Good afternoon, friends. Myself, Rajesh Khemani. I would like to invite the next session speaker, Rajshri Murkute. She is a Senior Director, Infra and Corporate Sector Rating with K Rating, one among leading credit rating registered with SEBI. She has 25 years of hardcore banking and credit experience. And right now she is leading infrastructure and EPC rating business with K Rating Agency. K Rating Agency is the only agency from India which has created a global sovereign rating platform also from GIFT City. So they are trying to work on the vision of one of chief economic advisor, and a lot of fund managers have been talking about the biases with global rating agency, what they call it white skin economy bias. So towards that also K Rating is working. With this, I request Rajshri ji to come here to grace the occasion.
This is fine, no? Page two. That's fine. Good afternoon, everyone. So I see there has been already a good amount of other interactions and presentations which have happened. So from my end, I would try to cover how at K Ratings we see the infrastructure trends emerging in the current scheme of things. We do rate a large number of infrastructure and EPC companies. In fact, there is a good market leadership when it comes to a rating coverage. So I would like to only focus on some of the key sectors which are very relevant and not going into the entire HML list as per what RBI defines as infrastructure. So quickly, as we move in terms of, putting a context as to why infra development is important and why do we discuss it so often. Needless to say, there is a strong multiplier effect of infrastructure investments, close to about 2.5 times on GDP, and therefore we constantly see a lot of emphasis from various budgets and government that there is a constant investments which have to be driven towards infrastructure sectors, and new sectors are also getting added. Now, statistics say that by 2030, close to about 42% of the overall population will be urbanized. Now, what does it mean? It actually means there is going to be an immense demand for infra resources, be it the physical infrastructure, social infrastructure, and even in terms of water and so on and so forth. So, therefore, there is a requirement of a very strong focus on infrastructure per se. Government has been pretty strong in ensuring that the impetus remains, pretty much focused and it doesn't get derailed in so many years. There have been so many initiatives which they have been announcing, so many schemes which has been launched. And as we see, some of them have actually taken very good shape in the last few years, attracting a lot of attention. And definitely for sure, infrastructure now is pretty well placed in terms of attracting capital revenues, both equity side as well as debt side, because of its stable yield platforms across multiple assets. There is a good amount of attraction and demand from the overseas fund investors, again, both from the private credit as well as private equity point of view. So put together, that's where we see that infrastructure will continue to play a fairly long and important role in the economic growth and the ultimate vision of Viksit Bharat and Atmanirbhar Bharat, so many other things which government has been emphasizing. So key messages in today's presentation, as we see here, the themes have been on the infrastructure capex, largely about the transportation, energy transition, as well as the technological-led initiatives. These are the three main themes that we continuously hear even from the government in their various schemes and policies that they are working around. When we come to one of the specific elements of infrastructure, which is road sector or the road transportation, of late, and especially in the current fiscal, we've seen a good amount of moderation in the overall awards and construction. We'll come to that in a little detail in the next few slides. But it's assumed and it's believed that because there is an additional 8% budget outlay announced in this year, possibly this is going to make up for some respite in terms of awards, which we have missed in the previous years. On the aviation or the aviation market or the airport infrastructure side, there is a bit of an irony. We are the third largest, we are ranked as third largest in the global aviation market, but when it comes to the penetration or the airport infrastructure availability on an overall basis, we still are under-penetrated. And which in other way actually also indicates that there is a very strong potential or demand for creating additional airport infrastructure in the country. There is a bit of lag in terms of the capex and the passenger growth revival that we have estimated for FY26, primarily because there were some delayed deliveries that are being assumed for wide-bodied aircrafts from majority fleet operators. Data center, the new kid in the block, and yet not so quick new kid on the block. It's been gaining a lot of buzz in the last few years. The current budget also is quite strong when it has announced a good amount of scopes for data centers. So yes, this after being introduced and introduced in the HML list also, we have seen a good amount of traction from the global investors as well as domestic lenders and investors in the data center space. It's all across. It's even with the power players, it's with the real estate developers, it's with telecom connectivity. There is a mixed demand that we are seeing across all of these players who want to now enter or foray into the data center space. On the energy transition, which we spoke of, so renewable energy continues to remain very crucial in the whole scheme of things. Our development and our capex has been very strong in the last few years. Yet there are certain hiccups which we are facing, especially with regards to the transmission and the evacuation infrastructure. So it's important that mere capacity addition of renewable energy may not really be useful till the time we also strengthen our storage systems, because else the grid stability related issues are something that will continue to remain unaddressed. Thermal power, which all through has been construed as dirty fuel and it was almost written off for some time, it's again regaining quite a bit of momentum. We've seen, in fact, government also announcing additional capacities to be introduced or to be launched in case of thermal power. Part of it is also replacement capex, because some of the old thermal plants are already getting phased off, so it will be used to replace them. But there is a good amount of additional capacity which is coming up basically to manage the base load demand. And when we are looking at economic growth for the next few years, say even at about 6% or 7%, and we assume a stable CAGR energy demand of 6% on an annual basis, it's actually going to be humongous. I'm in fact excluding the data center related power energy demand, which will also spill through. Yeah, so there is a good amount of demand, which is where thermal power continues to remain relevant even as we speak, but possibly the share of the generation from thermal power sources may come down to 60% from the current 85% that we see in the overall scheme of things. Transmission capex, as we said, mere addition of new capacities is not going to yield much results till the time we are able to evacuate that generated power. And that's where there is a lag which we observe, and it's going to be pretty challenging to ensure that it comes up on stream. We'll touch upon a very interesting parameter from CareEdge ratings point of view, which is called the credit ratio. It's basically a ratio of upgrades to downgrades. All the rating agencies use that. This, in a way, kind of indicates how the outlook or in what situation, how do we perceive the credit outlook for the underlying sector. So infrastructure credit ratio at the end of H1 FY26 stood at 8.54x. Largely, it's indicating a bit of buoyancy in the sector, but whether it is sustainable or not, we'll again touch base in the later few slides. So summarizing, on an overall basis, India's infra story definitely remains unfazed. There are a lot of geopolitical issues which are going on, but India's infra story continues to remain strong. On the capex front, if you observe on this slide, from 2021 to 2025, the annual capex, which was there at about close to 8 lakh crores, that, in our opinion, during 26 to 27, basically a 2-year period, if we compare the annual spending in this 2-year period, which is going to shoot to close to about 14.5 lakh crore, it indicates a 1.8 times kind of an increase. Now, where are the key sectors where this whole capex is being driven by the center? The broad sectors are transportation, as we touched upon, roads, railways, airports, the new age data center, and power sector. Power includes transmission also, and this is all put together center and state related capex. So this is where we start with saying these are the big corner themes from the government in terms of putting out an infrastructure capex outlay. Now let's look at one of the very important and critical sector, which is the road transportation. All through, there has been a good surge of road awards, especially coming in from the center. And that's what you can see in the left chart. Center's contribution towards overall project awards has been fairly strong, but for the last 2 years, where states have actually kind of increased their share. So on an overall basis, there is a good amount of traction and awards activity which is coming in from the states. The states to the right side of the slide, you can observe where the activity is actually pretty strong. And our estimate is that on an overall basis, with this additional 8% the budgetary outlay, possibly even center this year should end up with a good amount of awards. If not this year, at least FY27 should see some kind of a respite. Awards is one area, and then comes the execution on ground. Now, this is a very interesting chart. If you see up till FY24, or rather up till FY23, the awards in the road sector, especially the NH awards, have been very strong. And the construction thereafter remained with a lag. I mean, it was an increasing trend, but it remained lower than whatever has been awarded. Then there was a bit of slowdown in terms of the award section because the competitive intensity was very high. The existing EPC developers were unable to conclude the projects. Some of the risks which the previous panelist also spoke of, there are a lot of execution-related challenges which come through. Plus, NHAI also was unable to issue appointed dates-related aspects. So, put together, what has happened is the construction started to kind of holding up, and NHAI was unable to issue newer awards. Now in FY26, as we see here, the growth of award pace has not really inched up as much, but it has at least picked up to a certain level. And the previous year's awards have now started drying up. So the construction pace also is now looking little lower. Our estimate is for FY26, the decline will be close to about 9 to 10% in terms of NH road awards and execution. So initially, NHAI did think of improving a lot of participation by reducing the competitive, the bidding parameters, but it's actually led to a havoc. And there were a lot of undercutting in the prices, negative premiums, etc., which led to flooding of many bidders in the road sector. Eventually, none of them were able to either finish or even secure good amount of projects. So we looked at about 30 road SPV EPC players, acting developers, and looked at their order book. So the interesting trend that is observed here is one, from their core road sector dominated order book position, it's now taking place, it is now rather giving place to other sectors. So the prominent or the high profile EPC players realized that the competition is pretty fierce, and therefore they started, and plus the awards anyways were kind of languishing. So then they started looking into winning projects and EPC orders of different sectors, be it transmission, be it smart metering, and water irrigation projects, and so on. So that order book contribution and the composition underwent a change. And within road sector order book also, clearly there is a shift from center to states, as we had touched upon in the first slide. So this is where we see that there is a tilt towards the entire order book related fabric for the prominent road sector players. Let's move to airport infrastructure. Before we touch upon what type of capex is likely to come through for airports, it's largely driven by what is the demand outlook for our passenger growth in Indian airports. So there has been a V-shaped recovery. Everyone is aware, post-COVID, things bounced back very strongly. International tourism, everything bounced back very, very strong. Now in 26, we had actually originally estimated that the growth momentum will remain pretty strong and it will be close to about say 9% or so. We've revised it downwards to now about 7% to 25-27. That's primarily because we've seen there is a bit of apprehension which has started creeping in. There is regarding safety concerns, etc., because of certain unfortunate incidents which happened this year. So in terms of passenger movement, there is a decline, lower growth. If not a decline, that's a lower growth. And secondly, even in terms of to meet the demand, the fleet availability, whatever was the aircraft which was ordered, there is a delay in the supply and delivery of those wide-bodied aircrafts, which is to an extent also impacting the passenger traffic demand. I'll not touch upon the geopolitical factors because it's way beyond us, but definitely it is impacting the travel. So as I mentioned earlier, in terms of the global aviation market, India ranks third in global aviation. When we look from a global population point of view, we contribute to close to about 20% of that. But just look at the global passengers which are handled by Indian airports. We are handling close to about only less than 4% or just about 4%. So there is definitely a good amount of penetration and scope which is available to develop newer airport infrastructure. And recently there have been a lot of regulatory push and reforms which have been introduced by the regulator also, which has helped these macroeconomic demand situations to be favorable. Say for instance, even if you look at the favorable demographics, there is a rising working class population. There is an aspirational class which prefers to travel, do more of air travel. Tourism travel has increased. International tourism travel has increased. So all of these preferences have actually supported more of airport-related infrastructure to come through. And this is something which is also visible in the non-aero revenue. Now for the airports, the income profile, it's broadly two categories in a very simple language. One is the aero revenue, which is coming from your ticketing revenue, and which the airlines generally have to take care of. Non-aero revenue is something which is a derived demand, which comes due to the passengers using the airport. Basically, your retail, F&B related revenue, and so on and so forth. Now, this has definitely increased substantially on a per passenger basis. So which also indicates that the profitability aspect associated with the airports, which are regulated infrastructure, that has substantially improved, right? In terms of statistics, as we see in FY23, this non-aero passenger per revenue was about just 330 rupees. Our expectation is it's already crossed about 400 in FY26. So this is where the attraction remains. And the other big attraction for airport infrastructure developers is the city side development, which is a real estate and a mixed use development which they do. In case of Delhi Airport, the AeroCity is a very classic example, which is ultra successful, and that is something which also puts the airport infrastructure developers in a fray to bid for newer airports in prominent cities. So our estimate in terms of capex outlay for airport up till FY30 is close to about 1 lakh crore. If we look at the airports which have already been commissioned from 74 a decade ago, it's already touched 163. And the aim is to increase, I mean, almost close to about 230 by end of FY 2030. So this, if supported with a steady global aviation fleet which gets added in time, it should ensure that the entire prospects remain pretty strong. Overall, we expect that the capex outlay will be close to about 1 lakh crore in the next 5 years, including FY26, towards the newer airports which are getting developed. One has already commissioned of this in Navi Mumbai. Now I'll move quickly to the digital infra pace, which is the data center. As you can see here, there have been multiple reasons why this data center boom has kicked in the last few years, be it from the increased data consumption or increased AI usage, and it's only going to grow stronger. The more and more tech and digital initiatives are being led by all kind of companies, this AI usage and the digital consumption is only going to grow manifold. The rising internet uses, it also speaks about how many telephone connectivities have been issued in the last few years. Put together, we've seen a huge spurt in the data demand, and which is where the requirement of ample data centers, both for hyperscalers, for edge data centers, and so on and so forth, it's only growing manifold. The one big element here to observe is the cost which is required to set up a data center in terms of in India vis-a-vis some of the other global areas. We are very competitive, close to about 45% lower than the world average. And that's where a large amount of push and thrust comes from the global players to set up their data center capacities in India. Needless to say, we have a very strong engineering workforce also, which supports all of this. So before the budget-related announcement, whatever was the planned, announcements on capacities in data center, up till FY28, our estimate is it's going to involve close to about 60,000 crores of capex outlay. And in terms of capacity also, it's also going to kind of, go up. We are just about 1.4 gigawatt as we speak. And possibly about 2.5 to 2.8 gigawatt is where we believe by up till FY28 we should be able to commission. Now with the entire thrust from the budget, possibly this will also require and involve lot of other announcements which will come in the next few months, but that is kept outside the purview for the purpose of this presentation. But it's not just the demand which is going to result in a good amount of data center capex, right? What's very, very critical here is that there has to be ample land availability, power connectivity, which is extremely important, as well as the support EPC related equipment. So only if these three elements come together favorably and seamlessly, that's when these capacities are going to come up online as it is estimated. So that's going to be very important for us to look for how they will be able to manage the supply chain disruptions. Now we move to the power sector, which has been grappling with issues, has been gaining focus. Put together, if we look at this slide, it's a projected CEA estimates, wherein by FY30, close, 500 gigawatt of renewable energy is what has been estimated. We are kind of on par or at par in terms of achieving that when we look at the current installation or installed capacities in renewable energy. Already about 263 gigawatt in Jan 26. This is a slightly dated figure. But it's important is mere installation will not solve the problem. Right? If we look on the right side, it speaks of the contribution of each of these elements to the overall power generation. And that's where renewable energy is not yet catching up as much in comparison to thermal power generation. Despite being, in terms of nameplate capacity, the renewable energy is still quite high. But in terms of generation, it's still lagging. and about 46 gigawatt is still, of renewable energy is not yet got through any PPAs, which is extremely critical for any of the energy generation or the IPPs. That is something which is putting most of the developers in a limbo to bid for fresh capacities. Our estimate is this: while the overall generation by 2030 from renewable energy sources will be closer to 40%, yet it's very important that by then the storage-based capacities also catch up in time so that this entire picture actually becomes complete. So there is a change, therefore, in the tendering activity that we have observed. So as you can see here, the tendering activity towards plain vanilla solar vis-a-vis the mixed or with storage related orders which have come through in the last few years. I'll request you to focus on the right side of the chart and especially the last two columns. So if you compare 9-month FY25 versus 9-month FY26, there is a clear trend reversal, where the plain vanilla solar projects or the renewable projects were actually bidding pretty high. Now the trend in terms of the newer contracts and the bids which are coming out, the storage-based bids are something which are catching up very strongly. Close to about 64% of the total capacities which have been bid out are the renewable plus storage-based tenders, and it's becoming very relevant and important as well. So this is where the shift in the tendering activity is in the last few years. We've discussed on the overall generation mix, we've discussed a bit on how the renewable energy bids are coming through. And we also touched upon thermal capacities being added. Ultimately, transmission infrastructure or the evacuation infrastructure remains extremely critical. And as you can see here, up till FY 25-26, whatever was laid out in terms of target by National Electricity Plan of achieving and laying down transmission line kilometers, there has been close to about 70% of the target. That is up till FY 25-26. Now let's look at the larger picture, which is extending beyond 26, that is up till FY 32. So it says that close to about 9 lakh crore kind of capex has to be conducted for transmission related infrastructure. Yet what we have spent so far is only about 3 lakh crore. Now for any capacity in transmission to be commissioned by 2032, it's important that it gets awarded by 2029 at least, considering a 3-year period for execution. So by FY 29, the run rate or the ask run rate is that close to about 2 lakh crore worth projects should be awarded in the next few years so as to achieve the NEP target of 2032, and that's way too high by all standards. And here renewable energy capacities are pretty much getting added very fast because their gestation period is very small. It's about 18 months and so on. And with good technology, that's even getting faster. So 18 months vis-a-vis a 3-year setup of transmission, there is a huge gap which is getting worse. So this is a tall ask from the entire energy fix, and this needs to be addressed in a very strong manner. Put together, what have been the large roadblocks in transmission infrastructure is but naturally land acquisition related issues, because it's also on continuous tracts of land which needs to be deployed. There have been multiple clearance related issues, and also integration with renewable energy. Varying renewable energy will require a different level of technological advancement. So these elements have also caused some bit of a gap. There is a rising transformer demand, and our manufacturing capacities right now are not something which we believe are capable of meeting this particular demand. So these are the long, the parameters and the factors which are pushing back the execution of transmission infrastructure. Let's look at the overall cumulative capex outlay, therefore, only for power sector. Now here, as we see, built together transmission, conventional, as well as the renewable plus hydro. even if we go in a very basic assumption saying that close to about 45 gigawatt of renewable will be added on an annual basis, we've almost touched that this year. Conventional also about 90 gigawatt, 33 gigawatt I think is already under construction. So there is about 65 gigawatt which is yet to come through in the next few years. The number itself is very large. For power sector related capex for the next 6 years, we are looking at a 35 lakh crores, which is fairly large. So execution needs to catch up to ensure that all the other elements that we are looking at, they crystallize. I'll quickly touch upon some of the other segments, which is commercial real estate and warehousing. Both in some sense have been garnering a lot of private equity, lot of global investors, and also there is a InvITs and a monetization related potential which is emerging in case of these two blocks. So here the 3PL and the manufacturing segments have been the most prominent growth propellers, which have led to a huge demand in the warehousing segment. And we are expecting the capacity also to increase up to 500 MSF in 2030. There is again a strong PE participation. We've seen that multiple M&A activities which are kicking in through for warehouses here, and which is where they believe that this is a fairly stable asset yielding class and quite preferred asset class. ESG related norms also are something which are driving most of the investors to insist and ensure that all these infrastructures which are getting created, be it data centers or warehouses, the green element definitely holds, pretty much there. When we look from the credit standpoint, the debt to EBITDA metrics or the parameter that we observe, that's been fairly stable at 4.5 times, which is pretty much good and reasonable for a long-term infrastructure asset. The vacancy levels, especially in case of warehousing that we see, the grade A warehouses, that have remained very, very encouraging. Less than 10% for grade A warehouses is something that speaks of the strong demand, which ensures that the vacancy remains quite low, and therefore the refinancing related risks, etc., are not really very high end. Yet, again, we can't rule out the global headwinds which come through, and if there are any strong disruptions which will erupt, then possibly the medium-term outlook may undergo a change. Till that time, we believe that the story holds quite strong and remains favorable. And moving to the commercial offices, here again we would like to focus on the 6 major cities on the grade A office spaces. Lot of M&A activity here as well, and the vacancy rates here too we observe that's been closer to 15 to 17%, and in our estimate it's actually going to reduce even lower than that. There's a very strong GCC demand, BFSI, and the reason to come back to office kind of a syndrome which is kicking through, and that is where the flex space and GCCs are adding to a very robust revival in case of the commercial offices across especially the 6 major cities that we see. The new supply which is expected in 2026 of close to 60 MSF, we expect the absorption will still continue to outpace that. Rentals also have been quite strong, and they are now approaching near dollar rental levels, close to about 80, 90, which is good and strong. What is important to observe is, in case if the global uncertainty disrupts, then possibly the GCCs and the other majors who are now operating and are favoring very strongly in favor of Indian markets, in case if they withdraw their presence, which is where this may undergo a change. But till that time, we believe this particular sector is definitely going to hold quite strong. So demand, as we spoke, both in case of grade A offices and grade A warehouses, driven by using GCC flex spaces and the 3PL-led demand, basically to focus on reducing the logistics cost. Things are moving pretty much in the right direction. We've seen REITs doing very well when it comes to the commercial offices. Warehousing also, we've seen one InvIT which has come through, and we expect few more to add as and when the capacities start getting added over there. So this particular slide tries to capture the risk versus growth metrics for some of these prominent infrastructure sectors here. What we've tried to plot here is on the left side or on the y-axis, execution related risk is getting plotted here, whereas on the x-axis we have plotted the growth potential. The size of the bubble is basically nothing but a reflective of what is the absolute capex quantum that will be attracted by that particular sector. So if you see here on the extreme left side is the roads where execution has been that has been a challenge because of ROW related issues. And because of the recent decline in the awards, etc., we believe that the growth potential is kind of moderate, low at this stage of period. But power transmission, on the other hand, the demand outlook is very strong. At the same time, the execution also is quite heavy. The execution related risks also are quite heavy for the transmission sector. The rest, as we see here, are somewhere lying between the two spectrums. So if you recall the first slide that we spoke of, the center's capex outlay, especially in FY 26-27, and what were the key themes that they were trying to focus. We tried to evaluate the order book position of close to about 27 listed EPC entries and try to figure out what has been their order book trend. And it is actually mirrored whatever the center has been trying to drive. In the last 15 months, about 3.16 lakh crores is the order book addition in these entities. We've excluded L&T here. If we include that, that's going to be closer to 9 lakh crores. So, L&T itself is a fairly mammoth entity. So, we've just looked at some of the other prominent entities, and the themes are the same: energy, buildings. We look at roads and railways. Railways has been, again, largely central government-led related infrastructure capex. Again, track modernization, electrification, and so on. So that has not translated too much on the private players. That's been more a central government-led capex plan. So put together, these four segments itself are contributing to 70% of the overall new order inflow, which has come through in these listed EPC players. These kind of mirror or reflect the overall sentiment in the EPC sector. Now I'll come to that interesting parameter that we spoke of on the infrastructure credit ratio. As you can see here, this is plotted on a half-yearly basis, and the trend has been rising. In H1 FY26, the number actually went up to, it's gone up to 8.54 times. What it clearly reflects is, for every 8 upgrades, there is 1 downgrade, to put in very subtly. Now, this has been something which is similar to all the other rating agencies as well. Now, I'll tell you why it looks so sharply high. The large elements of infrastructure portfolio are basically comprising of they're largely project finance asset, so SPVs, individual SPVs, which would have a credit rating in a project phase fairly on a lower level. And once commissioned and the elimination of construction risk, most of them tend to have a much superior credit profile, which therefore starts reflecting in the credit rating also. And in case of stable yielding availability-based project finance assets, say roads or renewables or transmission assets, if there is a strong counterparty, then automatically post-commissioning, it comes pretty much closer to the counterparty related risk review. So what I'm saying here is, in this particular period, when we evaluated the rating actions, there were some large groups of SPVs which had got commissioned, both in case of roads as well as renewables, which led to an improvement in their underlying credit profile. And there were some large pockets of merger and M&A activity which went through, basically change in ownership. So from an existing sponsor, there have been bouquet of portfolio being sold to either a fund or to an InvIT, and that's where a strong sponsor holding and owning that portfolio further improves the credit profile, which is where we've seen that these upgrades were largely related to either a project commissioning or change in ownership. Is this sustainable? So that would remain, it needs to be answered, seeing what type of portfolio is remaining, how the activities are emerging in the next few quarters. And then the number can be a same number, lower number, or higher number. That all depends on exactly how the balance portfolio goes through when we are reviewing it in the next cycle. And this has been a fairly similar pattern even for other agencies, because infrastructure by design and by fabric, it is project finance. So it will have these typical underlying structures. So that brings to the end of my presentation with the credit ratio on infrastructure sector. So it kind of mirrors our outlook that we are holding on in terms of buoyancy and favorable credit outlook for the sector as a whole. I'll be happy to take some questions if you have any.
Questions, please. One small question from my side.
We can discuss at office.
I was just the entire presentation, right? A lot of details were there. So one thing attracted my attention. One thing that attracted my attention most was about the data centers. You said that setup cost in India is almost 40% less compared to the
45%.
international,
Yeah.
right? So is the pattern same for the operational projects as well?
No, we are saying about CapEx outlay. So now within data center also, what is the most important cost element in a data center is the land cost. So it all depends which part of the country is this additional data center being developed. Same capacity in, say, Chennai or a Hyderabad will have a different cost matrix, whereas the same thing, similar capacity being set up in Mumbai will have an absolute different dynamics. It will be close to about 70% higher within the two also. So the newer capacities, whichever are coming up, it's important to observe where they are being set up, and that will determine the price. This is for additional new setup of new capacities which are being laid out in data center. Operational data centers, I mean, there is no big advantage in looking at the capex right now, because all of it has already been invested and possibly some bit of recovery would have also happened. We are looking at only what is the incentive for the global players or GCCs to come and ensure that they have the data center bases in India. So this is one incentive which definitely will drive them in terms of the capex differential, the cost differential.
Thank you.
We've had this tax concessions. We've had tax concessions in GCCs, which have been announced in this year's budget. They've got a tax holiday till 2047, if I remember correctly.
Yeah.
Now, how much of that would impact an organization's decisions to invest in India? Because we're already 45% lower in terms of capex, and I'm sure the operating costs are also going to be much lower. So, with that influence to a great extent, or is just something a cherry on the cake?
Well, in terms of how much will it add to their overall bottom line, that's something that, when we discuss with multiple players, figure out how their economics plays out, that can be shared. But prima facie, what is happening is the tax uncertainty which has been prevailing in India has been something which puts most of the investors to kind of delay their decision. Either they go for lower capacities, or they would want to delay it till a further year and figure out whether the demand is real, whether the demand can actually go up from here. So it's more of a wait and watch kind of a strategy whichever GCCs have adopted. For them, it becomes instrumental to figure out that, one, the tax holiday gives them a certainty what to assume and believe in terms of returns for the next 20 years, if they do their own set of calculations, and which is where it can be definitely an enabler, if not something that they may want to wish it away, but it's definitely going to be an enabler when they have to take those key big investment related decisions, because it definitely calls for big money when they have to invest in large capacities, be it Hyderabad or be it Chennai or Mumbai. The outlay is going to be fairly strong. So for them, if they have made a clear decision that their horizon in India is going to be very strong, they see a very the macros being very robust, then this tax holiday definitely is going to give them that additional fillip to hasten that decision if they have to do that. But definitely there are multiple other caveats which the budget also did announce about being routed through an Indian player and so on. So that's a win-win situation for Indian players as well. So the larger and important thing for them is, I think, if the capacities can commission on time. So a mere tax may not be all in all for them to take a decision. What's important is if they want a capacity to come by an X month or an X date, what kind of clearances, what kind of land availability, connectivity, EPC capacity building, all that, what is the adequate resources available to ensure that the time doesn't get lost. Tax holiday is more of a sweetener in the whole deal for them to. Yeah, sure.
So we've got almost about 1,800 odd GCCs in India. I think that's what's the last newspaper report that I read. We've got almost. Is there a study being done in terms of when you make it 45% cheaper, or you may give them a cash, a tax holiday? How many more GCCs do we expect to attract to the country?
So presently, we've not done any of that kind of a study. It's too early. We've been actually only evaluating most of the players who are planning to set up newer capacities. So they have announced a degree of capex on the basis of firm demand from either a hyperscaler or an edge computing agency, etc. But has there been a newer and a fresher calculations whether basis this one announcement, what type of capex multiplier will come through? That I think they are also now evaluating and discussing little more in detail on the tax, the detailing part of it, and then come up with more firm plans. So for now, we've also not heard from any of our players as to what is the additional capacity that they intend to bring in merely because of this announcement. So I think it's only been an enabler when it comes to a discussion with their counterparts, saying that the government focus is therefore very strong. They are going to, they have been speaking quite a bit on the AI-led demand and why India should be considered as a global hub for all AI-related initiatives. So that seriousness is only getting re-emphasized, but the numbers have to come through only in some matter of time. Thank you.
Thank you. That was indeed insightful and very thorough in terms of getting a perspective of a rating agency and financial analysis and all aspects for success of a project, or what has been given. And